Hey friends, welcome back. So the previous video we looked at fixed income and जिसका हिंदी word है सुनिश्चित आय. Now let's go a little deeper into the world of fixed income, and today in this video we are going to see why as an investor one may have to look at fixed income as an investment as part of their portfolio. All right, so why fixed income should be part of your portfolio is the topic for today's discussion. Great. And then we will get into what are the various kinds of fixed income, what are the various risks in fixed income. It's a very exciting world. All right, let's get started. Okay, so fixed income. Fixed income. So today is why fixed income. The question is why. In the world of investments, let's look at it a little differently today, okay? So let's assume there is an investor A. So what does this investor do? So the investor works in a company. They work in a company, okay? So this is an individual. Let's call them an individual. Not an investor, an individual. So this individual A is educated and is working in a company. So working in a company. Now this fellow works in the company, and in return the company pays this fellow salary. Correct? Clear, everybody? So this individual A is working in a company, and this company is paying salary in return to this individual. Okay? Now, the money that A receives is kept in a bank, because the salary from company C comes into the bank. You receive salary in a bank, so the money comes into the bank. Okay, so this is the money which is maybe a savings account. Savings account. All right. So let's look at what are the 2-3 reasons why people keep money in a bank. Number one, it is safe to keep money in a bank. Correct? It helps in my transactions. If I need to pay somebody, those are called transactions. When I want to receive or pay or something, it's transaction. First, it is safe. It is safe to keep money in a bank, but it's not as safe to keep money at home because there's a possibility of theft. And third thing, the bank also pays me interest. Okay, so the bank is not giving me money, or a bank is not keeping my money with them for free. So the bank also gives me interest. So the bank keeps my money safe, banks helps in my transactions, and bank also pays me interest. Okay, this is a very important thing. So percentage. We will go deep into the world of percentage later, okay? Percentage. Now let's assume this fellow keeps rupees 10,000 in a bank, and the bank in turn pays him some interest, let's say 5%, okay? 5%. All right? Now, all this has been going on for a few months, few years, and it has been perfectly working fine. Then there comes a time when this A realizes there is a realization. Realization that, what is that? That 5% that I'm receiving for keeping money in a bank is not enough. This realization has to happen. If this realization doesn't happen, you don't take the next step. Why is this realization important? I'll come to that a little later, okay? But there is a time that this individual A realizes that 5% is not enough. And what is the next step that works in their mind? They look for alternatives. They look for alternatives. Alternatives of what? Alternatives of a bank account. Okay, alternatives of a bank account. Amongst the many alternatives, they see that equity investment is a great opportunity. Why is it a great opportunity? Because equity investments, the returns from equity investments are significantly higher. The word is significant. Okay? Significant. Now the question is, how much is this significant? If the bank has been offering me around 5%, it has been seen that from the equity market, you generate between 12 to, let's say, 15%. It's quite possible that you generate between 12 to 15% from your equity investments. But the thing is this return from the equity investment that you generate for yourself, because you realize that 5% from the bank is not good enough, this 12 to 15 comes with certain thing which is called risk. Okay? Comes with something which is called risk. And this is the return. So you generate a return for yourself, 12 to 15, but it comes along with certain things which is called a risk. Okay? I'll tell you why I'm talking about risk at this stage. Okay? So far so good, everybody? If it is fine, I look forward to receiving your comments. Okay? And we'll be more than happy to respond to them. All right? So let's get into this first. So you invest into the equity, you generate return, but along with that comes something which is called risk. Okay? Without getting too much into this, because we will have many more videos around risk, what this fellow figures out is that equity comes with some significant level of risk in few years. Certain years the risk is low, certain years the risk is significantly high. Hence, this individual, by this time he is no longer an individual, he has become an investor. Okay? This fellow then looks for an asset which delivers return, maybe not as high as an equity investment, but the risk is significantly low. So he is looking for an asset where the return is better than a bank, because otherwise he would have loved to keep the money in the bank. So he's looking for an asset where the returns are definitely much better than a bank, but it is lower than equity investments. You're lower than your equity investments. So this is where the role of fixed income comes in. Fixed income as an asset class has an ability to deliver a return higher than bank interest rates, but the risk of fixed income is significantly lower. So when I say significant, it could be even like 1/50th of that of an equity investments. All right? And the returns will not be 1/50th lower. The returns could be like 1/3 of equity investments, but the risk is like significantly lower. So you as an investor, if you are an investor, and if you are looking for a return which is higher than a bank, okay, but lower than equity, these class of people get invested into fixed income. Okay? Because if you are into fixed income, the risk is significantly lower compared to equity risk. Just for a quick recap, like what is risk? Risk is deviation of returns. Okay, deviation of returns. Deviation from what? From long period average returns. Okay. Now let me just quickly give you an example, and it will be so very easy to understand what is this risk. Okay. Suppose we have an asset which is delivering a return of, let's say, 12% and has got a risk of, let's say, 8%. What it means is that this return could be the long period average return, but 8% risk, what it means is that there have been years when the return has been plus minus 8. Okay, that means the return has been in the range of 4% going up to 20%. 12 plus minus 8. Okay, 12 plus minus 8 is a range between 4 and 20. So this is option way. There could be an asset class where the return is, let's say, 12%, but the risk is, let's say, 15%. There are possibilities, okay? In that situation, the return will be in a range of -3 going up to 27%, okay? So I'm sure all of you do know that equity funds, certain times equity delivers negative. So obviously the risk, I don't think I need to tell you, but the risk from the equity investments, the risk is higher than the return. But the risk of fixed income is significantly lower compared to the returns. So every investor, so what question is, why should somebody look at fixed income? Fixed income, inclusion of fixed income in one's portfolio helps in bringing down the risk of your portfolio significantly. It doesn't add to the returns, but it reduces the risk, because your portfolio is a combination of how much return you're delivering for an unit of risk. Okay, so that is the great portfolio. So for example, if I'm adding 1 unit of risk, okay, and adding 1.5 units of return, relative to this, this is option A, and option B, if I'm adding 1 unit of risk and compared to that I'm adding 1.25 units of return, okay, which one would you select? Obviously, I think people would definitely select this. This is the role, this comparative role is what is played by fixed income. So you create 2 portfolios, a portfolio in one which is only equities. Obviously, it will deliver a higher return, but relative to that, the risk is going to be significantly high. But if you add a little bit about fixed income into that, what will happen? The returns will come down a little, but the risk levels will fall substantially. Let me do one quick example and let's look at it, okay? So this is equity and this is fixed income, okay? So let's look at the returns. So equity, let's look at return is generating 15%, fixed income is generating 8%. Now the risk in this, let's say, is 20, and the risk in this is, let's say, 1%, okay? Now if I am having a 100% equity portfolio, so my risk and return is going to be 15 and 20, it's not going to be any different. But if I'm having a 50% equity plus 50% fixed income, what will be my return? My return will be 15 plus 8, 23, 23 divided by 2, it will be 11.5, and my risk will be 20 plus 1, 21, 21 divided by 2 will be 10.5. So instead of having a portfolio where my return is 15, risk is 20, I am creating a portfolio where my return is around 11.5, definitely a little lower than equity, but significantly higher compared to just a fixed income, but my risk is lower than my return, okay? So this is an accretive. I would definitely like to have these kind of portfolios rather than a portfolio where my risk is higher than my return. All right, so all those of you who are into this world of investments definitely are looking at equity as your primary source of assets in your portfolio, but looking at fixed income significantly helps in reducing the volatility of returns in your portfolio. Hope this empirical study helps you in appreciating the fact that the kind of strength the fixed income adds to your portfolio by reducing the risk. Risk is volatility of your returns compared to the long period average. If you're really enjoying these kind of videos, we will keep creating. In fact, there will be one new fixed income portfolio video coming up almost every day. We look forward to your comments. Please do like, share, and keep sending in your comments. We'll be more than happy to respond to them. All the very best and happy investing.